I'm just waiting for it to go live and then we'll start here. Hope y'all had a great week and weekend. Shanice, good morning, good morning, good morning. Hope y'all had a great weekend and a great week. Last week I was in New Orleans for the NAREB National Conference, and it was amazing. I keep telling you guys, if you haven't been to a conference, you definitely need to get to one. We're going to talk about where the next location is. But ultimately, thank you guys. Thank you. Chan, let's talk after Monday Mortgage Minute. I'll give you a call and then we'll discuss it and see what we can do. So it was a great time. Last week, I did win an award, top 10 loan officer for NAREB. And it was fun. I definitely want you guys to be able to go to the next one. The next one is in February. It's the middle one. We call it Midwinter. And it is in Fort Lauderdale. They just announced it in the national conference. So there is no excuse for anyone on this call to not be able to make it because you ain't even got to stay at the hotel. Go up. It's usually Thursday, Friday, Saturday, and Sunday is the conference. So once more details come out, we'll definitely be talking about it on here. But it will be in Fort Lauderdale in February. They usually do it at the end of the month, from like end of February pushing into March. So I definitely want to see as many of you guys there as possible now that it's in our home city because we got to show up. We got to show up and show out. But let's jump into it. So the Fed meeting was last week and they kept rates steady, which we figured would happen, right? They did hint at potential cuts in September as well, which we mentioned last week. Rates did take a sharp turn for the better last week, and that's because of the jobs report. Remember, I've been saying it since 2022. Rates get better during recession periods, and usually more real estate is sold during recessionary periods as well. But what's a big signal for a recession? No jobs or loss of jobs, right? So the Bureau of Labor Statistics showed that there were only 114,000 jobs created in July, which was below estimates of 175,000. Unemployment rose from 4.1% to 4.3%, which is the highest level since October of 2021. ADP's employment report, which measures jobs in the private sector, showed 122,000 new jobs in July, which was lower than estimates of 150,000. There's another concern as well, which is deceleration of annual pay increases. So sometimes we talk about how much year over year job stayers make compared to job changers. It has been consistently steady in the past few years. Somebody's not muted. Can't find you, God. All right. Deceleration of annual pay increases. Job stayers pay increase lowered to 4.8% from 4.9% year over year. Job changers lowered to 7.2% from 7.7%. It's very clear the tightening we're seeing, but it's actually we're not done with more of the data that shows why the stock market tanked last week, why Bitcoin and Ethereum are down 12% and 17% respectively, I think is the Ethereum number. JOLTS, which is Job Openings and Labor Turnover Survey, showed that the hiring rate fell to 3.4%, which is the lowest level in 10 years, not including COVID. Initial jobless claims, right? We talk about them all the time. These measure people filing for unemployment for the first time was at the highest level of the year at 249,000. Continuing claims are almost at 1.9. They're at 1.877 million, meaning that these are people that are still getting unemployment for the year. With not that many job openings, with higher unemployment, we're going to continue to see that number increase over time. Like I mentioned, there was a stock market sell-off in the midst of this. And this is really the key reason. It's all the jobs reports that came out last week. You're seeing the 10-year treasury come down as well. The recession indicators are finally showing, and we might be in for a tough third and fourth quarter economically. But once again, keep in mind that bad economy means better rates. Usually for real estate, and I can't stress this enough because it shows in the data, real estate actually increases, sales increase during recessionary periods because ultimately what happens when the economy is doing bad, right? People buy long-term investments. Long-term investments are mortgage securities and 10-year treasury. So when you're buying mortgage-backed securities, right, the more that you buy, the more competitive that market is, which means the lower the rate will go, the lower, because that's the lower the rate of return. Same thing for the 10-year treasury. The more people that buy 10-year treasuries, the lower the 10-year treasury return will become, which means rates are also jumping down. So ultimately, keep that in mind. It is a bad thing for the economy. We don't know what could happen in general with everything else, but at least historically speaking, right? During recessions, real estate usually comes out on top. The average rate for today is at around 6.80%. And actually, I checked Hometown Heroes rates before I got on. For conventional, it's at 6.125. Okay, 6.125 on conventional. For FHA's at a 6.625. But ultimately, I think that's literally the lowest rate on the market, especially considering no points or anything like that. So it's phenomenal. Case-Shiller Home Price Index for May came in, and we go off this report because it is typically the most accurate. It showed a 0.3% increase month over month and 5.9% home price appreciation year over year. Pending home sales, which measures contracts on homes, also came in last week, showing an increase of 4.8% month over month, but still less sales than this time last year. We're at about negative 2.6% year over year. Purchase applications data from last week. We're not really going to get into those numbers too much because that is for the previous week, right? It's not when rates dropped. So ultimately, it's still showing lower. But I think the report for this week, which we'll talk about next Monday, will show a huge increase week over week for purchase applications, especially for refinance ones as well, which are already up 30% year over year. During the conference, I had the chance to be able to ask Fannie Mae some questions about how they're tackling this new environment, and they were really receptive. I mean, in my opinion, you kind of have to be if you're in a room full of people like that, right? You can't just say no to a lot of things, but you would expect them to at least, kind of give some sort of pushback, which I guess they did in a sense. But some things that I asked were about student loans. Right? For those of you that don't know, they're the only agency still using 1% of the total balance to qualify. So I asked them about that. Ultimately, during the session, they didn't answer the question for me. But after the lady behind me worked for Fannie Mae, she told me that they're already, looking into that as well. I also asked about credit scores and being a bit more lenient with DU approvals on lower FICO individuals, right? There's a lot of people that look like us or don't have the greatest credit scores. There are some non-traditional credit tools they're implementing for borrowers, like rental history, which we know about already, but also something I didn't know, pretty cool. Looking at bank statements for self-employed borrowers to alleviate DTI decision-making on DU. So basically what that means is they're looking at cash flow analysis. So when you are filing 1099, right, you may make $75,000 that year, but what you're paying taxes on is 20. All right, we got to qualify you off of that 20. But if your bank statements using the advanced tools that we typically already use now on the back end, you guys don't know about, but ultimately using the same tools that Fannie Mae provides for us, utilizing the consistent cash flow of income that's coming in. If that DTI is at 49%, DU's taking into account the cash flow that's coming in, and knows that may actually be that DTI may be a little bit lower. So I thought that was pretty cool as well. I also asked about the drastic mortgage insurance premiums for lower credit borrowers that we're seeing, and they did tell me they're doing some testing as well. Same thing, they didn't answer that question during the session, but after the lady behind me told me as well that they're already working on that. They can't outright say they're switching things like that until it goes through smaller sample sizes in different areas, but looks like it's been top of mind for them, which is nice, I guess. Lastly, they also have a $5,000 down payment assistance program that has no income limit and is only based on where they currently live, not where they're moving to. But where they are currently, but they don't have too many census tracts yet. It is for the Tri-County area, right? Miami, Fort Lauderdale, West Palm Beach, as well as other places in the US. Very simple to be able to look it up to find out if that bar qualifies for it. It's called Home Ready First, if you guys want to do some research on it. But they will qualify for that $5,000 down payment assistance program. And from what I've read, it looks like it's a grant, not a second lien, but I have to do more research on it. And if it's a grant, because no, grants mean closing, person doesn't owe that money back. A second lien means we have to start tying it to the CLTV and things like that, right? So that's pretty much information from them. But yeah, Home Ready First. Typically only for first-time home buyers. Um, and it's different than Home Ready. Home Ready is going to be, you could use Home Ready as not being a first-time home buyer. And Home Ready does have an income limit. So Home Ready First is not, and also you have to be a first-time home buyer. But for those of you that came in late, we were talking about the rates dipping last week, where because of the jobs reports, kind of what the Fed has been doing by squeezing the market and increasing the Fed funds rate and keeping it steady at this point. You know, we talked about it. There's only two things that can help rates come down, which is loss of jobs and recession. And both of these things look like they're happening, or at least there's concerns about it in the market. And as soon as that happened, what did we see last week? Right, everybody was talking about rates dropping. But I don't know if you guys have any questions, any scenarios that you went through last week as well that you want to kind of discuss. Hometown Heroes only has $32 million left, by the way.
Thank you. I was just getting ready to ask that. Thanks, Mike.
No problem. Yeah, only has $32 million left. And we're August 5th. Oh man, so by the end of this month, the money will probably be gone. That's honestly pretty surprising, especially talking about the numbers showing that we're less sales this year over year, but I guess more people are utilizing the program too. Any other questions? No? All right. I do expect you guys to be there February, midwinter. I'm going to be on top of you guys to make sure that take some time out of your schedule to be at a NARED midwinter conference. Midwinter conference, and this is more so because Tiffany Washington, the vice president of YRD Miami, has been hyping us up, and we got a lot of checks to cash when they get here. And I need just you guys' help to be able to do that ultimately. But yeah, if you guys don't have any other questions or scenarios for me, have a great week, and we'll see you next Monday.
Thank you, Mike. Have a great day. Happy
Thank you.
Monday, everyone.